York. Hi, Jonathan York from Bay Financial Partners, looking at the investment markets. Another sort of fly in the ointment really with the latest data coming out of the US on the employment front. Very strong set of data there on the non-farm payrolls, 255,000 jobs created. Now that sort of pushes the monthly average back up around that sort of 200,000 for the last 12 months. It was also interesting as well to see hourly earnings were up a little bit as well, 2.6 year on year. So again, potentially a little bit of wage inflation sort of pushing through. The unemployment rate remained at 4.9. And what that does do, I say, it just poses the questions for the Fed really after a little bit of weak data on the growth, on the GDP numbers, but clearly the unemployment side is still pushing through at a pretty good rate. And does that make the sort of September meeting now a potential for a rate increase? Possibly not, but it just does keep the door just slightly ajar. Probably more likely to be sort of November or December for a rate increase in the US. It obviously pushed equities higher, and it's interesting now that global risk is now down to around a 7-month low on the sort of volatility risk index, which is again sort of quite interesting considering the events we've had over the last sort of seven odd months. This obviously all comes on the back of pretty dramatic moves out of the Bank of England after the Brexit vote, a further rate cut. And also a big sort of injection of bond purchases as well to try and cushion the blow from Brexit. Quite interesting really that sort of Nigel Farage and his sort of cronies who were pushing for the Brexit so there wouldn't be any stress on the UK economy, how wrong that is proved. And it's interesting to note as well, obviously Farage has just left the scene now and left everyone else to clear up his mess. Here in New Zealand, most economists and analysts are expecting a rate cut to take the OCR down to 2% on Thursday. That'll be interesting again to see the rhetoric that comes out as well to accompany that move. If it is along the lines of sort of further easings may be needed if required. That hopefully will take the New Zealand dollar down a little bit as well, and maybe just give a little bit of respite to the Reserve Bank, because at the moment certainly the high New Zealand dollar is causing quite a bit of angst. Now obviously what that will do potentially is just stoke the housing market even more, despite the recent changes to the lending criteria. That's really probably going to have pretty limited impact. If you're seeing lower rates and money is cheaper to borrow, then that is going to continue to see the house market sort of push on, and especially as well because it comes down to a basic sort of supply-demand imbalance. At the present you've got limited supply, you've got greater demand, and that's forcing up prices. Now obviously on the flip side of that is that term deposit rates for savers probably go down a little bit further. And if you are looking for some other options out there, there are plenty of other options to explore and alternatives out there in terms of sort of property trusts and dividend shares. They still create some pretty good investment returns on the income side without placing undue risk on your capital. If you're interested in discussing those, call us on 0800 867 323 or go to the website www.bayfinancialpartners.co.nz for lots of interesting articles, and we'll look forward to speaking to you soon.